Record. All right, good deal. So last week I had put up a post saying, hey, if anyone's interested in getting the quick analysis calculator to just kind of quickly run your numbers through a deal to see whether it's even worth looking further into, let me know. And so a whole bunch of you said, yes, I want it. I've sent it to you in your private messaging. And then I was like, maybe I should do like a class on it. And a bunch of you went, yes, yes, yes. So that's what we're doing today. So the goal for today's class is I'm going to use the calculator that I sent to most of you. And if you guys don't have it yet, you can actually get it in the welcome post. But what you can do is in this live feed on the Facebook group, if you just say, calculator, I'll go ahead and send you a private message with the actual attachment that I'm going to go through today. So not only am I going to go through the calculator, part of what I'm going to do with you guys is I'm going to be explaining as we go some of the financial principles, not financial principles, but some of the acronyms that are very common in multifamily real estate. Some of you are just getting started. Some of you have been doing real estate for a long time. Some of you might just be transitioning from fix and flip into doing buy and hold. So some of this stuff you might know, some of it you might not, but if you are going to be active in the world of multifamily investing, you really are going to need to know all of these things. It's especially important when you move into apartment buildings, which is where the more significant cash flow is. And before I jump into that, I did an interview yesterday with Brant Eilertson in his Facebook page, which is amazing. At some point, I want to do a shout out so some of you guys can go check out that group because he's got some really, really, really good stuff there. But one of the questions that came after the interview I did yesterday was someone was asking, well, should I, when I'm starting in cash flow, should I start with, less cash flow before I go into more cash flow? And here's how, and it was Z. So Z, if you're on this call, then now you'll hear the verbal version of it. But the gist of it is, I said, it's not about starting with low cash flow. But I think the question he was really asking was, or she, actually, I guess Z could go either way, and I haven't looked at your pictures, Z, so I'm sorry. But gender's fluid, they say, so whatever, right? Anyway, so here's the deal. It's not about trying to start for smaller cash flow, but the real question should be, should I start with something smaller before I jump into the bigger things? So I just wanted to spend a few minutes with you guys because it's really a very relevant question as you are building your business. So there is, buying a property, renting it out, and getting the cash flow. How hard can it be, right? It sounds pretty simple. Or buy it, fix it, rent it. What's so hard? But here's the reality. There's about 1 million moving pieces. Okay, maybe 1,000,003 moving pieces in all of that. And there's 1,000,003 different ways that things can go really right, really wrong, or a little right, or a little wrong, or just even. So there's all these different areas where there's learning. Even when you're experienced, you're still learning, because I'm telling you, there's not a single deal I do still after 16 years where something doesn't come up that I have not faced before. Now, in the very beginning, that used to just knock me out. Like, it would just knock me out. I didn't know what to do, how to do it, who to call, what questions to ask, and it felt like this monumental problem. And over time, what I've come to find out is every deal has a couple of those. So eventually you start getting just used to, okay, what's going to come up? And then the other thing that you get used to, or you become more skilled at, is problem solving. And I have literally taught and trained thousands of investors over the years. And one of the things that I always say, especially if I'm standing on stage and I'm speaking to a big group, say there's 500 people, if I could give one message, I mean, I want to teach the whole time. I love teaching, as you guys can probably tell. But if there's one message that I could send and that I could just put deep into your soul, it would be this. You're not paid to be a real estate investor. Real estate investing is the vehicle. In this business, you are a highly paid problem solver. You're a highly paid problem solver and a highly paid project manager. That's actually why we get paid. Because when someone goes into investing, if they can't figure out how to solve a problem and they can't close the deal, it's done. If you become skilled at, just sucking it up and being resourceful and solving the problem, then you get to buy the property. All right, so that's something I want to just instill with you guys, because when I was new, nobody told me that. Nobody told me that it's challenging, it's difficult, you're going to want to pull your hair out sometimes on a good day. On a bad day, you're really going to do some damage, but that's just the reality. If you want more in life, you got to become more. It means you got to be resilient and strong and creative and be willing to problem solve and not just have everything handed to you, right? So the first time I had something come up that was unexpected in real estate, it knocked me on my back. And now I look back and it was so stupid. It was so silly. One of these days I'll share. I don't want to get too far off track, so I want to teach you guys financial analysis, but maybe in the Q&A, if you guys remember, if somebody wants to hear that story, let me know, and I will, I'll tell that story to you guys, just as an example of problem solving. But that thing that happened was so lame to me now when I look back, and I was like, man, but it knocked me on my back for 3 days. For 3 days, I was like, oh my gosh, it was my first deal. My career just started. It's already over. And I mean, I'm not a dramatic person in general, but I was like seriously high drama on that one. And then the next deal, there was something, and the next deal. And then now I'm like, I'm still annoyed. Don't get me wrong. It's not like I'm like, oh, yay, a problem. I'm like, dang it. I'm still irritated. I'm annoyed. I'm ticked, but I'm not really fazed, right? It's like, okay, fine. What's the issue? All right. What are the potential solutions? This, or this. Let me make some phone calls. Let me see what we can do. And I just go into problem solving mode. Okay. So if somebody had told me that when I was new, my entire journey for the first couple of years would have just been easier. Not that the deals are easier, but psychologically and mentally, it would have been easier. I wouldn't have always felt like I was failing, which is kind of how I felt. And then now I've just come to realize that's just real estate. No big deal. All right. Anyway, neither here nor there. Today we are here to talk about financial analysis. So for those of you who already have the calculator, cool. Well, I'd say you could pull it up, but it's not really going to help you to pull it up. Plus, before our call, I went on and I added a couple of things. So for those of you who do have the calculator, if you want the new calculator, which has a couple of additional calculations on there, mainly because I wanted to teach them to you guys today, I have a quick analysis 2.0. So if you want the calculator, say that, I'll send it to your private message over the next day or so. But let me get on and share that, and we'll go through it. All right, so here it is, passive income real estate quick deal analysis calculator. And now I'm thirsty, so give me a moment. All right, so the idea of this calculator is this is not like some super in-depth calculator where it's going to have 100 different things. Look, there's 1, 2, 3, 4, 5, 6 fields. 6 fields for you to fill out. Not a whole lot. All right, but it's a really good way to just quickly put in some basic information to see whether this is worth looking at or not. Okay, and let me see. I see there's a chat. I'm just going to pull it up. Please send calculator. Oh, okay. So don't send me the request for the calculator in the chat, because there's no way I can't multitask that. What I mean is in the Facebook group, like put it in there, like on live or on my 15-minute announcement, put it there, and I'll send it to you like later. But in the meantime, take notes. If you guys do not have something to take notes with, go grab a notebook or some paper and a pen and get ready to take some notes, because not only am I going to show you the calculator, I'm going to teach you, I'm going to educate you about a lot of different things related to the financial analysis. So make sure you have stuff. All right. Oh, Mark, I don't have a calculator. Don't worry, Mark. I'll hook you up later. And you'll get the 2.0. Just do it on the string. Okay, sorry. Okay, let's go. So here we go. The calculator, when you get it, it's just going to be in Excel. All right. So the way I have it is, I have to lock it before I send it to you guys. There's going to be 6 cells here. These are for you guys to fill out. So there's some like basic data points, like purchase price, down payment, percentage, interest rate, amortization period, number of units, and average monthly rent. Okay, so purchase price can be, and again, this is for you to analyze an existing deal, maybe something that's already cash flowing Or the other way you could use it is if you were buying something that you were going to be doing the BRRRR strategy on and turning around, you could use this to analyze how it would perform once it's turned around. Okay, so this analysis doesn't involve or include all of the financial analysis around doing like the rehab and stuff like that. All right, down payment percentage. Okay, so that's basically how much money you would either put down, or if you were doing the BRRRR strategy, that would be the amount of equity you would leave in the property. Okay, so if we're doing the BRRRR strategy, realistically, you're going to be more like 25 to 30% as far as a down payment. And what that impacts on here is, one, it helps you to figure out the cash on cash analysis. For the cash on cash, that would be a straight purchase. Okay, for the BRRRR strategy, you're probably going to have recouped some of that money. But for the way it's impacting this calculator, it's taking the purchase price, it's subtracting out the down payment percentage to come up with that. The net would be the loan amount, and that's what's going to impact your debt service or your mortgage payments. If it looks like I keep looking over to the right, it's because my picture is over there and I'm literally just keep distracting myself. So I don't know what to do about that. I love you guys. All right. Okay, interest rate. So interest rate is going to be the interest rate that our loan is going to be when we purchase the property or when we refinance the property. Amortization period. So amortization period, when you're buying a single family home or a personal residence to live in, a typical amortization period would be 30 years, right? So 30 years, all that means is that when they come up with your purchase price minus your down payment, that net loan amount is going to be spread over 30 years. You're going to pay the principal over 30 years. Right now I have 25 years in there. So, but 25 years is more common in the multifamily, like apartment space. So for those of you who are looking at doing apartment buildings, let's say 10 to 40 units, well, actually 10 plus units really. 25 years is not uncommon to see. And if you're dealing more in the 1 to 4 family, not uncommon to do 30 years. You can even put in 15 years if you were curious, like, if I wanted to try to pay this off quickly, what would that look like? Okay, so these are all inputs. You can change it to whatever. All of the numbers are going to just flow through automatically. All right. So I'll leave some of these inputs right now just for explaining it. And then when you guys get the calculator, you can play with it, put in different numbers, and just kind of start to get a sense for how different changes that you make, whether you make a higher down payment, how does it impact the cash on cash, or if you change the interest rate, how does that affect the return on investment or the net operating income, etc. All right. Then we have a number of units, and then we have average monthly rent. All right. So like when I'm actually doing a full analysis, I am not just taking number of units and then average monthly rent. I will actually go in and, because sometimes with a multifamily, particularly an apartment building, you're probably going to have different size units that have different size rents. Okay. So understand that this is somewhat of an oversimplification so that you can get a quick answer on whether to proceed with that. I just never want anyone looking at this going, oh, but we've missed depreciation and appreciation, and what about the mortgage pay down? And that's not what this is for. It's, let me get some quick numbers so I can see what is this deal going to potentially look like, and if I'm interested, cool, then we go do a complete and full analysis. All right, so what I've done here basically is, what is the average monthly rent based on the number of units? So even if it was like some were 500 and some were 900, and I added them all up and it came out to $5,600 a month, I'll just throw in 700 because I know 8 times 700 equals that. So it'll give me a fairly accurate number. All right, so here you have your down payment amount. Now, when I send this to you guys, I will lock all of these cells because I was adding things, I haven't locked it yet. I will lock all these cells. The purpose of me locking them is so that you don't accidentally delete the formula, because that would be unfortunate. All right, so the down payment amount is going to be the purchase price times the down payment percentage. And then the net of that is the loan amount. So the purchase price minus the down payment is the loan amount. All right, so let's talk about net operating income. All right, so here's where we're going to start giving you guys some education in this space. Net operating income, also known as, let's put this in here, NOI, is probably one of the most important numbers in multifamily real estate. All right, it becomes a little bit more relevant when you get into apartment buildings compared to 1 to 4 family, but it is still relevant in 1 to 4 family. If you're dealing with, especially a commercial lender, they're going to be asking about the net operating income. And here's net operating income at its most basic level. Net operating income is all of the income that's coming in. So if you think about your property as a business, it's all the money that's coming in from the business minus whatever expenses are going out. Now, for the purpose of financial analysis, we do not consider debt service, which is AKA mortgage payments, as an expense of the property. And here's the reason. Somebody might be buying the property cash. Somebody else might be buying the property with a 20% down payment. Someone else might be doing a 1031 exchange and putting down 50% down payment. Now, all of them are going to have different cash flow. And it wouldn't really be fair. And when you get into multifamily, the net operating income is what helps to create the value of the property. And I'll explain that a little bit in a minute. But if we were looking at, oh, well, this guy's cash flow is this much, this guy's is only this much, and this guy's is in between, none of that should impact the value of the property because that is only related to how they are financing it. All right, so net operating income is only the performance of the building without taking into account debt service or mortgage payments. And the reason you guys want to start learning some of the vernacular is as you move into multifamily real estate and in apartments, when you're speaking to brokers and you're educating them about what it is you're looking for, you want to speak the language that they are used to speaking. Otherwise, it's going to be obvious that you're new. Part of my goal as a coach and a mentor for the people I work with is for you guys to sound experienced, because you're going to get a lot more traction from the realtors and brokers if they think you're experienced. And the main reason is because that they trust that you know how to close. And someone who's new, like you don't know, like you're just stumbling through, but hey, that's just the rite of passage. You got to do what you got to do, but I want to help you sound like you're more experienced. Okay, so you're going to say net operating income when you're referring to the performance of the building. All right, also when you're asking for financials, you would ask for a pro forma financial statement when you want to know about the rents and the expenses. So write that down. I'll write it down here. This won't stay on the calculator, but just so you know what I'm saying, pro forma. Every once in a while I see it without the space, but I think it's technically has a space in it. So pro forma financials are basically the financial statements that are going to show you what the seller is saying that the performance of the property is. Now, what's realistic or what's reality might be something slightly different than that, but it's their representation, what they're telling you about. All right, so net operating income, so the income, which would be rents. What else could be income if you think about it? Well, I realize you guys can't talk, but I'll give you a moment to think. If you have storage units on site, vending, laundry, anything else, late fees, pet rent, pet fees, anything like that, that is all revenue, it's all income. And you add all that up and that's the top line. Expenses are everything that you have to pay out. So that is property taxes, insurance, utilities, maintenance, service contracts, property management, legal fees, advertising fees, like any expense that you have to pay out in order to run your property is considered an expense, except the mortgage. All right, so we take the income minus the expenses and that we get our net operating income. All right, because the calculator is going to just take, again, it's a quick calculator, it's just going to take 40% of the income, which tends to be a reasonably like national average as far as expenses, but you just have to know property by property, it's always different. But generally speaking, if you see a pro forma with less than 40%, you probably want to just bump those expenses up to 40 because there's probably something that the seller has left off, right? Like maybe they managed it themselves, but you're going to have property management. All right, so this calculator is going to assume that there's 40% expenses to give you net operating income. All right, so as let's say we change so I want you guys to watch this number right here. So watch the net operating income. So as you change the average monthly rent, let's say that you were going to do some improvements, you were going to be able to raise the rent to $775 a month and 8 units. When I hit enter, watch what happens to that net operating income. from 36,000 to 40,000. Okay, so raising the rents increases the net operating income. I'm gonna put it back. All right, I just want you guys to understand the relationships between some of the different numbers. All right, let's move down. Delete this so I don't accidentally end up keeping it in there. I'm gonna move down to annual cash flow. All right, the annual cash flow is the net operating income, so income minus expenses, less the debt service. Okay, in layman's terms, mortgage payments. In the multifamily world, we call it debt service. That's the language you want to start using. All right, so over the course of, and I just built into here like an amortization. Yeah, I'm an accountant by trade. I mean, it's been like 16 years, but I'm a CPA, so I'm a numbers nerd. So anyway, so I built a little amortization thing in there, and the mortgage payments are basically coming out. Okay, so we have the net operating income there, less the mortgage payments equals annual cash flow. Okay. The other thing about when we get to multifamily investing, everything that we do, everything we look at is in terms of annual. Okay, so if you're talking to a broker, you're talking to a realtor, don't talk about things in terms of monthly. It will be like this giant red flag. I'm new, I'm new, I'm new. Okay, we always speak in terms of annual. I mean, conversationally, I'm looking at monthly, obviously, but when you're doing analysis, everything is based on annual. All right, so your annual debt service or your annual cash flow is net operating income minus debt service. Oops. All right. Cash on cash return on down payment. For those of you who already have the calculator, this was the last piece of it. I added cap rate and debt service coverage ratio to the 2.0 because I wanted to teach it to you guys, and then I'll have it for you in the future. But the cash on cash return on the down payment, that's basically going, so this is the annual cash flow, which is pulling from right here. So it's showing up there. And then the down payment, which was 20% of whatever number you put in here, was right there. And that's pulling in here. So the cash on cash return is a calculation that takes the annual cash flow, all right? And the annual cash flow is after paying the debt service. So it's literally what is left in the bank account at the end of the year, projected. All right, so I have 15,000. Let's say we ran the property from January 1st to December 31st, and on December 31st, we had $15,258 sitting in our bank account for the property. All right, then we divide that by the down payment that we did. Now, actual cash on cash return would also take into account any monies that you paid out. This is, again, it was intended to be a simple, quick analysis. But when you're really analyzing cash on cash, you probably paid out appraisals. You probably paid out points to your lender to get the loan. You probably had title fees and things like that. So any money that it actually took you to be able to close the deal, really all of that would normally be in cash on cash return. Okay, just be aware of that. But in this case, let's just say we want to see, well, how is this working compared to our down payment? So 15,000 divided by 68,000. So that would tell me that I have a cash on cash return of about 22%. Okay, so 22% cash on cash return. So yeah, not bad. So if, for example, we decided, well, we have a little bit more money. I'm just curious, like, how will the cash flow change? How will the cash on cash if I go ahead and put down 30%? Okay, so I just want to show you that. So let's say I was going to put down 30%. Okay, so that changed my down payment to 102,000. All right, then I'm going to come down here and I'm going to say my cash flow increased to 17,887. So it went up by a couple $1,000s. Now my cash flow is 17,000 divided by 102,000 down payment. Hold on a second. My cash on cash return went down. Why is that? I'm making more cash flow. And this is where the whole idea of leverage comes in. And it's why real estate investors use leverage, because you can take a pool of money and you can spread it out by getting loans so that you can get more property, you can get a better return on your money. Now, cash on cash return is neither a good or bad thing. It just is. It helps you to make decisions. So for example, if I have $102,000 and I'm like, well, should I put down 30% on this building or should I put 20 and then go use the other 10% on something else? This can help me make a decision. So if the other money I was going to put down was going to get me a 10% return, I would look at this and go, oh, well, you know what? I would get 17% if I had all 30% down. That's going to be better than me making 22% on 20% and only 10% of my other. So if my goal is to maximize my return, I would look at that and go, you know what? I'm going to put my 102,000 there. You know, but if I had another opportunity where I could take that other 10%, go make 30% on it, I'm probably just going to put down 20% so I can maximize my cash on cash return. All right. And sometimes, put that back to 20. Sometimes it's not, with cash on cash return, it's not always people's objective to maximize the percentage of return. And that's why I say there's nothing right or wrong about it. It might be your objective. Like, let's say that, you know, you're going to get 17% instead of 22, and you're like, oh, that's kind of a bummer. I'm going to get a lower percent return, but I'm making an extra $2,500 in cash flow. So it depends on what your goals are. If your goal is, I want to maximize every single dollar I put out, then you're going to want to put down the smallest down payment possible. You're going to make the least amount of cash flow also, but it will maximize your return. But if your goal is, no, I want to get as much cash flow as possible, so I want to put as much down so that I have the smallest mortgage possible, then you would be looking to put down a larger down payment so that you get more cash flow and you don't care so much about the cash on cash return. So maybe you just say, well, man, as long as I can make 10% or 15%, I'm good. That's how you look at it. There's no right or wrong. It depends on what your goals are as an investor. All right, now let's get down to cap rate. So write down cap rate in your notes, and cap rate is short for capitalization rate. Capitalization rate. Nobody says capitalization rate, everyone says cap rate, but that's what it's short for. So cap rate in real estate, and this cap rate is really more towards, again, multifamily like apartments, but every once in a while you'll see it with the 2 to 4 units. It really looks at the performance of the building compared to the purchase price. All right, so the performance of the building is the net operating income. So the net operating income, at this point we had revenue minus expenses equaled $36,000. Okay, if our purchase price was $340,000, we'd have a 10.67% cap rate. So the calculation is net operating income divided by purchase price. Okay, net operating income divided by purchase price. I'm actually going to ask you guys a question. You can throw your answers in the chat. When I send these calculators out to you, would it be helpful if I wrote, since these will all be locked, you won't be able to look at the calculations in there, okay, again, because I don't want you to accidentally delete them. Would it be helpful for you if over on the right, I made a note as to what those calculations were? So if that's something that it would be helpful to you, go ahead and in the chats, say so. And then when I send it out, add it. And if it doesn't matter, guys don't care, then I'll just leave it as is. You can let me know on that. All right. So here's more about cap rate. So cap rate will help you just quickly make a decision as to which property is going to be more profitable. Okay, because it's just a relationship between how it's performing to the price. So for example, we see 10.67 right here. So that's based on 36,000 of net operating income and 340,000 purchase price. Let's just say that the seller was asking for 400,000. Let's put in 400,000 and let's go down and take a look. Okay, so now the net operating income is the same because the purchase price doesn't impact the performance of the building, right? It's revenues and expenses. So we're still making 36,000, but now we had to pay $400,000 for the property. So that gives us a 9% cap rate. That means we still have $36,000 coming in, but we had to pay more for it. So cap rate is something where the higher the cap rate is, the better financially performing for you the property is. Okay, so, and then let's say if we went down to, let's say 280,000. If we negotiated the deal down to 280,000, that would give us almost a 13% cap rate. All right, so generally speaking, between 9 and 10 is a pretty good, pretty solid cash flow rate. You'll see them even as low as 8 be considered good deals. In San Diego, I haven't looked in San Diego for a long time, but when I was the chief financial officer for a property management company, here, and there was had like 1,000 luxury units. 3 of the buildings were in San Diego. The market cap rate was like 4%, which means people would buy a building and get only 4%, which means they were basically breaking even or losing money because, depending on what their mortgage was. So you want the cap rate to be as high as possible. If you can get something that's between 8 and 10%, that's usually pretty decent. It's going to depend on what your loan looks like. Lower the interest rate, the lower the cap rate can be and still work. Okay, so cap rate is something. So if you're looking at one building and it has 7.2 cap rate, you have another building that's 9.7 cap rate, the 9.7% cap rate is the one that's going to be the better performing for you, or better financially for you. There might be other reasons that you would go buy the 7. Like, let's say you bought that one and you were like, well, it's 7% now, but their market rents, they're not at market rent, like they haven't raised rents. There's all these renovations they can do in order to get higher rent. So there might be the opportunity to take that 7 cap and get it performing to a 10 cap. And over time, I'll do more classes that are a little bit more advanced that talk about kind of that turnaround thing. On Friday, Wednesday, no, on Saturday. On Saturday, I'm speaking at a mastermind here in San Diego, and I'm going to be teaching those members of the mastermind about taking an underperforming apartment building and doing a turnaround on it and just how that impacts the numbers. So I'll develop a presentation for that group, and then at some point I'll come back on here and I'll give that to you guys as well. So for those of you who are doing apartment buildings, or you like the idea of doing a value play and taking it, turning around and increasing the cash flow and the value, that's actually my specialty. That's something that I've specialized in for many, many years, and it's super fun. So eventually I want you guys to do it. All right. Even so much that back in, I think, 2011, I made a course called How to Make It Big, Flipping Apartments Using None of Your Own Money. Because I love the idea of going in and doing a total management turnaround and increasing the income, increasing the value. So anyway, that's where part of why I want to lay this good foundation with you guys is because you really have to understand how to, crawl before you walk and walk before you run. And so right now it's like, let's understand all like the basic terminology and the calculations so that when you start moving into those different levels of real estate, you're prepared to receive the next level of training. But if I try to give that to you right now and you've never heard any of this before, you would just be like, what in the world is she even talking about? Okay, so this is really going to layer on the additional trainings that I'll do with you guys, as the year progresses. Okay, so that's cap rate. Then we have debt service coverage ratio. So debt service coverage ratio, that is something that the lenders are very, very interested in. So if you think about it, it's always good to think about everything we do in terms of the other person, whether it's the realtor, the contractor, in this case, the lender. What would make a deal safer from the lender standpoint? If the deal had, let's say that you had $36,000 a year of net operating income, but the mortgage payments were all also $36,000 a year. So that means that literally every single dollar that you have coming in performing has to go back out in the form of a mortgage payment, which means you have no cash flow. Lenders do not want to see you with no cash flow. They want you to make money on it. I don't think that they actually care about you making money on it, but if you think about it from the deal standpoint, it's safer because if you're making more money than you need to make the mortgage payment, if something comes up that you weren't expecting, and trust me, stuff comes up, you're able to carry it without it completely devastating you financially and you going into foreclosure. And that's what they're protecting it against. So what you'll find is when you're dealing with lenders in this space, they're looking at the debt service coverage ratio. And they all have different requirements about DSCR. Those are the things. Sometimes you also see it as DCR, debt coverage ratio, but I've seen it more commonly, DSCR. They will range anywhere from 1.1. And if it was 1.1, if your lender said, we want to make sure you have a minimum of 1.1 debt service coverage ratio, it means that they want to see that you have 110% of the mortgage payments you have in your net operating income. Okay, so that means all the money that comes in, let's make it easy. Let's say that your payments, your yearly payments were going to be $100,000. Okay, so $100,000, they know that you're going to be making as far as mortgage payments. They want to see that your rent minus expenses comes out to be $110,000. so that you have that 110, you can pay out the 100 and you're still making 10,000. That's the point one. So some lenders are okay with as low as that. What I have found is that most lenders will incentivize you as far as interest rates, like they'll give you a better interest rate, or they'll loan you more if you have a higher debt service coverage ratio, or they'll give you like less points, less origination fees. So they incentivize you to have a higher debt service coverage ratio because it makes the deal less risky for them. So more commonly, I see lenders who really want more like 1.3. And when I did my refinance, my portfolio refinance most recently, they were looking for, well, they said they would do it at a minimum of 1.2, but if I could hit 1.5, then there was a whole bunch of different benefits. And for me, I think mine was at 1.7. So I had it cleared because I had a lot of cash flow with these properties. So the higher the debt service coverage ratio, the more the lender is relaxed and knows that you have plenty of money coming in to cover the mortgage and to cover anything else that could come up, and for you to actually have positive cash flow. Okay, so if we did this and our number was, 1.03 debt service coverage ratio, you would know, yeah, there's no way, like these numbers just don't work. And so you could start playing with, okay, well, what would I have to do? I'd have to have higher rents, or I'd have to have lower purchase price or higher down payment. Like you just start playing with it so that you can see how that impacts it. Okay, so in your notes, you can make something like, say something like, the higher the debt service coverage ratio is, the better. Okay, also the higher the cap rate is, the better. Okay, I'm looking at all your little notes. Thanks, Mark. Mark's sending me some. I don't exactly know how this webinar thing is brand new. If you guys were on the live call with Matt Skinner yesterday, all about raising private money, I'm sure you could laugh at how inept I was at figuring out lives, but I think I got it down now. But I'm still learning the software, so I know real estate really well. By the end of this year, I'll know how to deal with this stuff really well too. Learning is painful, guys. It's all right. Okay, and it looks like a couple of you are saying yes, it'd be helpful to have those notes in there, so I will do that. Okay. All right. Anyway, those are the basics as far as financial analysis on everything. What I'd like to do is, I wonder if I have to stop sharing for this. I'm going to see if I can unmute you guys, because this time I can't see you. When we did the other one that we weren't live on, I could see our faces. Let me see. All right. Well, if you have a question, for now, go ahead and type your question. I'm going to look around here and see if I can figure out how to unmute you guys. Let's see. Allow to talk. Oh, I'm just going to click allow to talk on everyone. Allow to talk. Allow to talk. I'm sure there's a better way to do this because there's not like a huge amount of people on here, but if there was like 100 people, I couldn't do this. So, all right. So, oh, I see. And you guys have muted yourselves. Okay, so I have a few of you guys unmuted. Does anyone have any questions? And are you guys on video? I don't see anyone. So I don't know if no one's on video or if it's just not showing.
I'm on video.
You are. And who is that? Is that Jeff?
That's Jeff.
Yeah, but your box lit up.
I'm trying to ask you a question. I'm typing.
Okay, let me see. Mute audio. I'm going to actually see if I can pull your video up. No? All right. Well, clearly I have more learning to do as far as, oh, here we go. Gallery view. Well, nope, still no videos. Okay, well, that's okay. Well, as long as, okay, but go ahead and ask your question, Jeff, and I'll answer it. And eventually next time I'll hopefully get to see your face. Oh, you can just talk it, Jeff. I can hear you.
Oh, okay.
Yeah, go for it.
Let's see. I was going to ask if you have access to private lenders that want to do apartment deals.
Well, when it comes to
how
that,
can I find some?
Yeah, okay, that's a great question. So for one, networking on the page, did you see the interview I did yesterday with Matt Skinner?
No, I did not.
Okay, so on the page, it was a live interview, but it's still on there. We talked for like 55 minutes, and this guy has raised like $100 million for a deal. Yeah, and I interviewed him yesterday. He had some amazing stuff to share. So definitely go watch that. But just networking within the group, networking in general, but go watch that because you're going to find he gave a lot of really good information on that. I'm not intending to build this group to make like make direct connections on that, because I want it to be a little bit more educational, still networking, but it's definitely there to facilitate. So you can be reaching out to people that you might, connect with, that might be a good fit. Because some people have money and some people have time. And some people have time, but they don't really want to learn how to do all this. So if you can just develop relationships with people who, like, if you're like, hey, I'm willing to go do the work, I'm willing to learn, get trained, do the work. If you're willing to put up the money, that's like the perfect fit.
Right. Well, I have plenty of time.
Awesome. So yeah, but that's what I'd suggest, Jeff, is just start networking, but go watch that call from yesterday, because you'll probably.
Perfect. I'll do that. Thanks.
Awesome. My pleasure. All right. Do we have any other questions? If you have a question, you can unmute yourself, because I've allowed everyone to unmute.
Hey, Stacy.
Yes. Oh, Mark. Again, your box is lit up.
Thank you. I don't know. This is a weird Zoom. Usually I see a lot of other faces, but I don't know what you're doing right now. But
well, what it is in order to go live on Facebook, because I wanted us to be able to do that, I had to upgrade to the webinar version. So okay. It's brand new. I haven't done it before. So I'm sure there's something I can click somewhere. Anyway, I'll be on YouTube trying to figure it out for the next time, because there's something different about it, clearly.
No, thank you so much for the group. My goodness, you're totally giving us value, 100%. I'm much appreciated.
My pleasure. Did you have a question, or are you just like being nice?
Well, I always have a ton of questions. I like your calculator. It's very ninja. It's very quick and dirty. I think that it's definitely a plus to add some notes on the sidebar there.
Okay.
It's very clear, very concise, so people can actually utilize the tool and get to making offers. These are Comma Club offers, so it gets a little bit higher.
They're what? They're what offers?
They're bigger offers,
Oh, bigger offers, yeah.
Yeah, I mean we're working on a pretty sizable one, like 165 units currently right now. So
awesome, I love it.
It's a project for sure. And the things you find out from the brokers is amazing once you start digging, so.
Awesome. All right, well, cool. Well, reach out if you have questions about it as you go. I'm happy to help you.
Anybody else here?
Yeah, any other questions, or is everyone just listening for everyone else's questions? All right, there's a Q&A. I'm going to check real quick in the Q&A just to see if we have any other questions. If we don't have any other questions, we'll go ahead and wrap up. But I do want to make sure if you guys have questions, you get them answered.
I'd like to get a copy of that cheat sheet there, your calculator.
Yeah, absolutely. So Jeff, what you can do is, if you go on the Facebook page, in the, because this will be posted as a live, in the live or in the announcement about it, just put, calculator, or can I get a copy of the calculator? And I'll private message you with the attachment. Okay, perfect. That's great. And for anyone, like I said, anyone else that's already received it, if you want the 2.0 version, which is the one that will now have notes on it and have a couple other calculations, just go ahead and say, calculator 2.0 or whatever, and I will send it to you as well. Well, thanks. I appreciate it. Thanks. Of course, it's my pleasure. All right. No other questions? Go on once. Go on twice.
Thanks.
All right. Oh, hey, Dave. How's it going?
Good. Appreciate it.
Oh, my pleasure. Do you have any questions? You just want to say hi?
Just want to say hi and bye.
Love it. Love it. All right, guys. Well, it's been a pleasure spending this time with you. Happy New Year to everyone. I'm super excited to spend this time with you guys. Have an amazing evening. And and remember, for those of you who want to be on the call on Monday, Jennifer is going to be, I'm going to be working with some people that I might be able to squeeze in, but Jennifer is going to be teaching you guys a class on the BRRRR strategy. And so Jen and I do all of our real estate, well, obviously we're married, so yes, but we do all of our real estate together. I'm like the detail person, and I'm, we have different roles. She's our strategist, so she always comes in very high level, and we really rely a lot on her corporate America high level leadership to guide like our whole business direction. So she's going to be taking that approach and using some of the tools that she had created when she was an executive with Home Depot and Target, and turned them into real estate tools. And she's going to show you guys not only how to do the BRRRR strategy or teach you about it, but also how to use the tool she created. I'm sure she's probably going to do the same thing where she'll send it to you after the call. but really to teach you how to look at things from a different level of strategy. So as you're building your real estate businesses, you could do so a little bit more strategically. I can't think of another word. So that one is going to be Monday, same time. We're going to try to do the classes always at the same time, 4 o'clock Pacific, 7 p.m. Eastern, just so that you just kind of be in the habit of that. So if you'd like to join us for that, that one's in the events. And otherwise, have a great weekend, guys. And I look forward to seeing you. Well, once I can figure out how to see you on the next class.
Sounds
All
good.
right.
Thanks.
Take
Bye.
care, guys. Bye.
Happy New Year, everyone.
Happy New Year to you guys too.
Crush it.